You've heard that the BRRRR method can build a portfolio with a starting check. And that's true, but only if you understand the 4 numbers that decide whether the strategy actually works at today's rates. I refinance investors out of the BRRRR deals every single month, and I'm going to show you what the YouTube gurus leave out: the seasoning period, the refinance LTV, the rate gap, and the one market condition that's killing BRRRRs in 2026. Now, if any of those 4 terms are new to you, stay right here, because this is the video that is going to help save you from a very expensive mistake. Now, let's make sure that we're all on the same page before we start getting into the numbers. BRRRR stands for buy, rehab, rent, refinance, repeat. Now, that's a very simple idea. You buy a distressed property that is below market value. You fix it up and then you force it into appreciation. You place a tenant in the property to generate rental income. Then you refinance it based on the higher appraised value. You pull out some or all of your original cash, and then you take that money and you do it again on the next property, the repeat. Now, done right, this is a way to recycle capital to build a portfolio without having to come up with a full down payment on your every single deal. That's the promise. But what's the problem? The problem is the math behind the promise has changed dramatically in 2026. And most of the content that you're seeing online is still off the playbook from 2020 to 2021, when the rates were at historic lows. We're not there anymore. The playbook doesn't work the same way anymore. So let's talk about exactly why it doesn't work anymore. Now, the first thing that gurus gloss over is the seasoning period. Seasoning refers to how long a lender requires you to have owned a property before they'll let you do a cash out refinance. And for most conventional lenders and DSCR lenders nowadays, that window is actually 6 months. Some are even 12 months. Now, that means that after you buy a property, after you rehab it, after you place a tenant, you could be sitting on a stabilized property for up to a year before you can even pull your capital back out. Now, think about what that does to your timeline and your holding cost. You've got a hard money or bridge loan that's running at 10 to 12% interest, and that's every month. You're waiting for a month of expensive debt service eating into your equity. Now, here's the difference where DSCR loans make a big difference, or here's where DSCR loans make a big difference. DSCR stands for Debt Service Coverage Ratio. It's a loan product specifically designed for investment properties, and it qualifies based on the property's rental income, not your W-2 income. Now, one major advantages in the BRRRR context is that many DSCR lenders have significantly shorter seasoning period, and some offer no seasoning at all on cash-out refinances. I would say the average is 6 months. Some go down to 3 months. And then there are the very rare exceptions for a premium borrower with no seasoning. I want to make sure that's clarified. Now, I want to also be transparent. The no seasoning programs typically have tighter guidelines. You're usually looking at a minimum credit score of around 680. It's probably a little bit higher than that. Loans starting around $75,000, and the property still needs to cash flow. But for an investor who runs a clean rehab and placed a good tenant, eliminating the 6 to 12 month wait is a massive advantage in 2026. Now, I work with lenders who offer both. If you want to know which one fits your specific timeline, drop a comment below or give me a call. The number is going to be in the description. Now, let's talk about the number that surprises investors the most. The LTV gap on the cash out refinance. LTV stands for loan to value. On a DSCR cash out refinance, most lenders are going to keep you capped at 75% of the after repair value. And some programs go up to 80%, but that's generally going to be for a rate and term, not a cash out refinance. That means that you're going to retain at least 25% equity in the property after we get done with the refinance. Now, let me give you a real example. Say you buy a house for $120,000, but you put $40K worth of rehab into it, and the after repair value comes in at $210,000. Total cash in is $160,000. Now at a 75% LTV, the lender will give you a loan of $157,500. That's 75% of $210,000. Now, your bridge loan payoff might be around $130,000. So after paying that off, you'd be roughly $27,500 in cash back. That's not nothing, but it's also not your full $160K back. You've still got skin in the game. That is part that the gurus always skip. They show you the potential of the strategy without showing you that the refinance will rarely return 100% of your capital, especially in a market like today where appraisals are coming in conservatively. You need to model this math before you buy the deal, not after. This is the most important concept in the entire video, and that is the ending with most BRRRRs, and this is the one that's ending the most BRRRRs deals in 2026. When you run a BRRRR deal, you're borrowing twice. You take out the bridge loan or hard money loan during the buy and rehab phase. In 2026, those rates are running right now about 8 to 12%. Some programs are as high as even 14 to 16%. And that is just temporary financing, generally on a 12 to 18 month note. Then once the property is stabilized, you refinance it into a permanent DSCR loan. As of mid-2026, qualified DSCR borrowers are seeing rates in the 6 to 7.5% range, depending upon where your credit is and your LTV and DSCR ratios. The math has to work for the rate to drop, not at the bridge rate. So here's what I mean. Let's say you refinance into a $157,500 DSCR loan at 6.75% on a 30-year fixed. Your monthly principal and interest payment is going to be around $1,221. Now, you have to add taxes. You got to add insurance. You have to add any HOAs if that's applicable to your situation. And now your PITI is going to be around $1,350. Now you need to rent that. You need rent that covers that and covers your margins in with it. So most DSCR programs want you to be at least a ratio of 1% to 1.25%, meaning your rent needs to be at $1,350 to $1,700 a month just to qualify and maintain a positive cash flows. Now, here's the catch. A lot of markets right now, the math is actually extremely tight. Rents haven't kept up with pace where the rates and appraisals land in 2026. The rate gap is the spread between what you have borrowed at and what you have to refinance into. Now, that used to give investors enormous relief, but and even a drop rate from 12% to 3.5% in 2021, that was a game changer. But a rate drop from 11% to 6.75% today, it helps, but the landing zone is a lot thinner. And you also need to make sure that, yes, you're cash flowing the property, but your margin, right? How much money do you need to make? A lot of investors, they get into a predicament. Well, I got to refinance out of this deal now. Okay, that's great. But what's happening if you're getting at a rate, a DSCR rate of 1, you're breaking even. Where's the money, right? What happens if something goes wrong? In a lot of markets today, landlords are giving concessions because the rental market's so tight. So you got to be very specific about where you invest in these rentals right now. And if you follow my Facebook page, you can find, I give you that information. I tell you where appreciation is and what markets for rentals, what markets for after repair values, for all of that, for appreciation. Find out. There's markets like Austin, Texas, that it's Texas, right? It's got to be great. Wrong. It's actually one of the worst areas right now to acquire a rental. Now, real quick, if the BRRRR method is on your radar for 2026, hit the subscribe button or follow button right now. Next Wednesday, I'm going to drop a full breakdown of the DSCR or conventional financing. I might actually do a different video, an alternative video on the BRRRR method. I'm still up in the air. We'll find out. And I'm going to go over what the complete comparison, if I do the DSCR versus conventional, what that comparison is literally to the decision that determines which refinance product that you should be using after your BRRRR method. You don't want to miss that one. Or even if I do, if the BRRRR method's right for you video, that's also another video you don't want to do, because it's going to talk about, are you setting yourself up for success? So you don't want to miss it. Subscribe, follow, like this video. Let's get going. Now, let me give you the 3 headwinds that are making BRRRR methods harder this year. Number 1, appraisal conservatism. Appraisers in 2026 are being conservative, especially in markets where appreciation has slowed or plateaued. That's meaning that the ARV and the after repair value, that you're counting on to drive your refinance is actually coming in lower than investors are projecting. If your deal pencils at 220 and for the appraisal, and the actual appraisal comes back at 195, your entire cash out math changes. And this is happening consistently right now. So you need to make sure that you're underwriting your ARV at the conservative end of the comp range, not at the optimistic one. Like I said, there are certain markets where appreciation is real, but most markets are actually declining right now. I see it every day. Number 2, the sub 6.5 rate threshold. Now, there's a floor below which BRRRR deals are starting to work really well again, roughly 6.5% or lower on the DSCR refi side. We haven't consistently been under that threshold in 2026. Most qualified borrowers are actually landing in the mid 6s to low 7s. And until rates drop meaningfully, the cash flow margins on the refinance BRRRR properties are razor thin, especially in higher priced markets. Now, number 3, materials and labor inflation. Now, rehab costs have not come down. Lumber, drywall, roofing, skilled labor, the costs that go into your renovation budget are still elevated compared to pre-pandemic levels. That means that your all-in cost is actually higher. That means that you need a bigger spread between purchase and your ARV just to make the same return that you would have gotten 3 years ago. Deals look good on paper are actually losing margin in the field and practice. So where does BRRRR method still make sense in 2026? The Midwest secondary cities. Markets like Columbus, Cleveland, Indianapolis, and Kansas City are still offering properties where you can buy at a significantly below market. And then you can hit a realistic ARV with a light to moderate rehab and generate rents that cover your DSCR requirements. Now, property values are lower, so your absolute dollar amounts are more manageable and your LTV cap bites a little bit less. And the bigger pockets community is actively working on deals in the Midwest markets with all-in costs under $150,000 and still finding the math penciling. North Idaho workforce housing. Coeur d'Alene and the surrounding area still has a workforce housing need that supports BRRRR. Now, particularly in the entry-level and mid-range price brackets. So rent demand from the region's actually growing workforce population is real, and the value add plays in that range can still produce viable DSCR loans. Does that mean you go buy a $600,000, $700,000 house? Nope. But you need to make sure that you are in the entry level to moderate level so you can make viable rent for that transaction. Spokane, that's kind of a borderline, right? And I say that as somebody who operates here and lives here. Spokane has a lot going on for it. The median home prices are still significantly lower than Seattle. Rental demand is steady, and appreciation has been moderate. But in 2026, the math on a full cash-out BRRRR in Spokane is tight. The gap between purchase price, rehab cost, realistic ARV, and what the appraiser will give you, layered on top of the mid-6 DSCR rates, means that you need to be extremely selective about the deal. You can still execute the BRRRR in Spokane, but it requires sharper buying and more conservative projections than it did 2 or 3 years ago. Now, the rule of thumb that applies still everywhere is buy 15 to 25% below current value. Keep your all-in costs around 70-75% on a realistic ARV. Remind you, 75% is going to be the average cap at cash out. So you want to be really 65 to 70% if you want some money back. And you run your rental projections against a post-refi PITA before you close on the buy. And I also want to give you some insight. If you're not from this area, most individuals that live in Idaho or want to live in Idaho, they don't want to live in Spokane. I moved from Idaho to Spokane because I'm reasonable. I'm going to go buy me a house that's going to be, I'm going to get a little bit more bang for my buck in Spokane, right? But most individuals, they're not like me. I'm pretty neutral when it comes to a lot of the stuff. So I'm reasonable with my cash. So I'm okay to live in Spokane. Now, however, most individuals, just because, hey, now I can go to Spokane, I can buy a cheaper property than I can in Idaho. I'm going to make that cash flow with that person that wants to live and work in North Idaho, right? They're right next door. You're wrong. It's not going to work like that. You're rarely going to find an individual who wants to be in Idaho actually move over to Spokane. I'm one of the rare. Now, if you want a step-by-step checklist that walks you through the exact refinance timeline for a BRRRR deal from a bridge loan to a DSCR cash-out refinance, comment the word BRRRR below, and I will send it to you directly. That checklist covers the seasoning milestones, the documentation that you're going to need for your DSCR package, and the key decision points where most investors, they're getting tripped up right now. I'm Robert Homewood with OpenLane Funding right here in Spokane Valley, Washington. I work with investors across the Pacific Northwest and nationally on DSCR bridge loans, and I'm helping everybody finance with these BRRRR refinances as well. So if you got a deal that you want to run by me, you want a free feasibility report, the number's in the description. Call or text me at any time. I'll see you guys next Wednesday for the DSCR and conventional breakdown. Possibly if the BRRRR method video is going to be best for you. But this is going to be a good one. Either way, I'll see you guys then. Have a great one.